The story of the turtle traders is probably one of the greatest trading stories of all time. It started with Richard Dennis and Bill Eckhart, two great commodity traders who argued about whether or not great traders were born or made. Richard believed he could teach people to become great traders, and Bill thought that they were born. So eventually they made a bet, and they took out ads in Barron's, the Wall Street Journal, and New York Times looking for individuals who wanted to become traders but didn't have trading experience. They had over 1,000 people apply for that first group. They interviewed about 80 and ended up with 13 traders that became the original turtles. Now, the name came from Richard Dennis, who traveled to Asia and saw these turtle farms where they were growing turtles, and eventually he said that he was going to grow traders just like they grow turtles in Singapore, and the turtle traders were born. So the trading strategy itself, there was a lot of secrecy surrounding the methods that they used for a long time. They had to sign away their rights to release that information for a given period, and then when certain turtle traders were revealing these quote-unquote secrets, there was a little controversy over there. But really, it was based on a very easy concept, which is using a Donchian channel. So let's take a look at what they did. This trading strategy is a breakout trading strategy, and we're looking for a trend. So it's a trend following trading strategy. You're looking for these nice trending markets to capitalize on and to capture significant trends and moves. There were really two systems that the turtles used. One was a short-term 20-day breakout. The second was a longer-term 55-day breakout. And with a 20-day breakout, as an example, they would take the high and the low of a 20-day period and look for a break above or below to initiate a trade. So when price moved above that 20-day high, they would buy. With their trading, they didn't even look for a close above that high. They just looked for a move one tick above that high to initiate a long. A short was the opposite. When they saw that the move was below the 20-day low, they would sell and initiate a short trade. The exits were based on a 10-day close. Actually a 10-day low. They would close longs when there was a 10-day low in the market, and they would close shorts when there was a 10-day high. Now, these rules might sound pretty simple, and it's interesting to hear Richard Dennis himself say, this is a quote from Market Wizards, if you want to pick up a book and read more about Richard Dennis and how he traded. He said that, I always say that you could publish my trading rules in the newspaper, not one would follow them. The key is consistency and discipline. Almost anybody can make up a list of rules that are 80% as good as what we taught our people. What they couldn't do is give them the confidence to stick to those rules even when things are going bad. So for them, it was consistency. It was following the rules, sticking to their plan, and using a few other things to help them see success. Now, if using this type of approach, let's take a look at a few tips here. Now, really what they were doing was using a Donchian channel break, which was introduced decades before, but turtle traders made the Donchian channel popular, or more popular. So their real goal was not to make winning trades every single time, because they didn't expect it. They expected a low winning percentage. They expected most of their trades to be losers, or not big profits anyway, but they expected that eventually they were going to catch some really big moves that would make up for those losses and give them the profits that they were looking for. So if you're following these rules and you're using a Donchian channel and following along with what the turtles did, you have to expect big profits to offset those losses, but in general, a low winning percentage, unless you decide to alter the exits. What they also did is incorporate money management and position sizing, which they found to be crucial for their success. These are concepts that we're going to introduce in more detail, but for their trading, they couldn't just put all their eggs in one basket. They needed to be able to continue to take trades when they saw breakouts and entry conditions for them to trade. The third thing that really set the winners apart from the losers was, for them, This was a very methodical approach. The traders who let emotions get in the way, the traders who broke the trading rules, locked in profits, or adjusted things, for the most part, those traders didn't do as well. And the traders who went on to be money managers or trade their accounts and see substantial profits from their trading, they really were committed to following their trading rules. So as a trader, I would encourage you to take a look at the concept, because it is your standard breakout trading strategy, but you might want to consider additional types of exits, because for the strategy itself, if you were to use it and apply it methodically, for most traders, it could be very, very uncomfortable because of the low winning percentage and because of the discipline and the time involved. So it's definitely not an approach for everybody, but since it has been successful in the past, it's a popular concept and idea, we'd like to introduce it here. So let's go ahead and take a look at a chart. So here we have a chart of the Emini S&P 500, and I'm using a daily chart since that's what the turtles did. Now, with this chart, we see a Donchian channel plotted in green, and what this is really doing is showing us the 20-day low and the 20-day high. So traders using this concept, they would look for breakouts when we break below that 20-day low. They would look for breakouts above the 20-day high to initiate a position. Now, if we take a look at this move, an entry short here would have been pretty profitable, and you could have really seen a substantial move, almost $6,000 for every contract traded. Keep in mind this is a daily chart, so with a daily chart you're going to see larger profits and more risk, but this is a pretty nice move here. However, the exit that they used was a 10-day high when they were in a short. So they would have been getting out maybe here, and a lot of that profit has been lost. So if you follow the rules just like the turtles did, you're going to be leaving a lot on the table. And you have to understand that the real goal is to get that huge winner, that big move, that substantial move that makes it all worthwhile. For some traders, it's just very uncomfortable to wait and have that happen. And this is where you might consider another type of exit, looking for a reversal or using another indicator that tells you that that trend might be changing, especially if you're going to use it on a smaller time frame. So that's what the turtles did, and this is how you can incorporate a Donchian channel into your trading plan.